Hi, and welcome back to yet another exciting week of the Lazy Money Game. In this week's episode, I will start by giving a short update to my portfolio, and afterwards we're going to take a closer look at the annual shareholder letter from Berkshire Hathaway, since there are a lot of lessons to be learned regarding investing and to life in general. So let's start with a quick portfolio update. The first thing you immediately notice is that there was a green circle for this week's episode. If we go to the portfolio values tab and check out the value, you can see that my portfolio is up compared to last week. And coincidentally, I'm actually back at exactly the same level which I were 2 weeks ago. So that is the reason why you see a green circle this time. But more importantly, the cost has not changed, meaning that I haven't done any new investments over the last 14 days. If we then continue to my favorites tab, namely the dividends tab, then we can see that February has been quite an extraordinary month since I received more than $700 in dividends. And the reason for this is due to the fact that Nexstar Media Group has increased the dividend and due to the fact that South Jersey Industry was taken private, meaning that they were paying out dividend in a month where I actually did not expect to receive it. So all in all, this has this extraordinary result. And 3 months from now, of course, I cannot expect to receive dividends from South Jersey Industry due to this privatization. But at the same time, as you recall, I did a new investment into Citigroup, which should increase this amount by 100. So in total, I should expect this number to be $75 higher 3 months from now. So when we're looking at my estimated average yield, we can see that I am now above 3% due to this dividend increase in Nexstar Media Group. So naturally, this of course affects my forecast. So if we go to the forecast tab here, since I can now update my number from February, then if we go all the way to the end, then we are much closer to the $3,000 mark than we were last time before the update, since the model predicted around $560 in this month. But naturally, this forecast for 2044 will be much lower next month, since I have no way of getting close to the prediction here, which is 564, since I would expect to receive a little less than 300 here in March due to the fact that South Jersey Industry paid out earlier than what they used to, since they were taken private. So of course, this number will fluctuate a lot. It's simply just so you can follow it. It doesn't really have a meaningful saying yet. It just gives you a very, very rough estimate. And finally, we can go back to the overview arc and scroll all the way to the top, just so you can see how each individual holding has been performing over the last period. And I think the most noteworthy movement here is within Activision Blizzard, which I have highlighted here, since they are now in positive territory in my portfolio. I can only take this as a sign that the market now has a stronger belief that Microsoft is going to be allowed to do this all-cash transaction deal where they want to acquire Activision Blizzard for $69 billion. Unfortunately, there has not been any news out that has stated this clearly, that this will be the case. So of course I can be completely wrong. If we then continue to the annual shareholder letter from Berkshire Hathaway, then this is a 10-page document. And the first page, if you have never seen this before, this is truly what compounding interest does to your performance, since on the first page, they always state how Berkshire Hathaway has been performing compared to the S&P 500. So for instance, in 1965, they achieved a return of 49.5% compared to the 10% from the S&P 500. And if you scroll all the way to the bottom here of the first page, then you can see that the average annual gain on Berkshire Hathaway has been 19.8% compared to the S&P 500 of 9.9%. And if you look at the period from 1964 through 2022, this gives Berkshire Hathaway a total return of more than 3.7 million% compared to the S&P 500's 24,700%. An interesting conclusion that I have seen a lot of investors making from seeing the first page of this annual shareholder letter is that Perhaps Buffett and Munger has now become too old to run Berkshire Hathaway since they are not earning as much as they used to. They are not seeing the same return. And usually they point out 2015, where they lost 12.5% compared to a positive return of the S&P 500 of 1.4%. And also here in more recent years, in 19 and 20, where Berkshire Hathaway had a return of 11% and 2.4% compared to a 31.5% and an 18.4% return of the S&P 500. But I mean, Buffett and Munger are truly long-term value investors. So for instance, if you look at 2022, they had a return of 4% compared to a negative return of 18.1% of the S&P 500. So I think it is too early to say that they are too old to run Berkshire Hathaway. And just to add an additional comment here, Buffett and Munger has been crystal clear here. If you are investing in Berkshire Hathaway, you should not expect to continue to see an annual return of 19.8%. They themselves expect this number to drop significantly since their operation has now become so large that there's simply not enough attractive opportunities in the market for them that would significantly impact their return in a positive way. They are simply too big in that sense. So you need to keep that in mind if you are considering doing an investment into Berkshire Hathaway. If we then continue to the next page, then what is it that Berkshire Hathaway is actually doing? So as it states here, Charlie and I allocate your savings at Berkshire between two related forms of ownership. First, we invest in businesses that we control, usually buying 100% of each. Berkshire directs capital allocation at these subsidiaries and select the CEOs who make the day-by-day operating decisions. When large enterprises are being managed, both trust and rules are essential. Berkshire emphasizes the former to an unusual, some would say an extreme degree. Disappointments are inevitable. We are understanding about business mistakes. Our tolerance for personal misconduct is zero. So this is the first part of businesses that Berkshire Hathaway is acquiring, and typically these are the ones which we are not seeing in the stock market since they simply just acquire 100% of the businesses. And as they emphasize here, they appoint the CEO to completely do all the day-to-day operation in the business, and that Berkshire Hathaway has this extreme degree of trust in the CEO. They simply do not interfere with the day-to-day operation, and they actually expect the CEO to make business mistakes since that will be inevitable. But at the other hand, at the same time here, they have zero tolerance for personal misconduct, meaning you have to have the highest degree of integrity in order to be a CEO of one of Berkshire Hathaway's businesses. If we then continue to the second category, in our second category of ownership, we buy publicly traded stocks through which we passively own pieces of businesses. Holding these investments, we have no say in management. Our goal in both forms of ownership is to make meaningful investments in businesses with both long-lasting favorable economic characteristics and trustworthy managers. Please note particularly that we own publicly traded stocks based on our expectations about their long-term business performances, not because we view them as vehicles for adroit purchase and sales. That point is crucial. Charlie and I are not stock pickers, we are business pickers. So, here is one of the very valuable lessons I think we can already learn here, that Buffett and Munger are not trying to pick stocks, they are trying to pick businesses, since they think as owners if they are doing an investment into a business, meaning that they will only buy if they think that there's long-lasting favorable economic characteristics and that there's a trustworthy management. So if they invest in a business, then it is for the long run. It is nothing about what this business will do within the next quarter or within the next half year or perhaps within the next year. It is looking much further ahead to try and say, can they predict in any meaningful way where this business will be in 10 years' time? And the next paragraph. Over the years, I have made many mistakes. Consequently, our extensive collection of businesses currently consists of a few enterprises that have truly extraordinary economics, many that enjoy very good economic characteristics, and a large group that are marginal. Along the way, other businesses in which I have invested have died, their product unwanted by the public. Capitalism has two sides. The system creates an ever-growing pile of losers while concurrently delivering a gusher of improved goods and services. Schumpeter called this phenomenon creative destruction. And this paragraph is actually also quite interesting because due to the fact that Buffett knows that he has made a lot of mistakes, he fully recognizes the consequences of those, namely that he only has a few enterprises that has truly extraordinary economics and a lot of investments that had marginal economic characteristics. And in this paragraph, he says nothing about rebalancing his portfolio, saying that you should sell some of the shares which have increased the most, since he looked at it from a business owner perspective and saying, why should I sell my business just because it is performing well? He is truly willing to have much more risk in a company that has been performing extraordinarily well. And you can really see that with his holding in Apple, since it takes up more than 44% of their total investment these days. If we continue to the next paragraph here, one advantage of our publicly traded segment is that episodically it becomes easy to buy pieces of wonderful businesses at wonderful prices. It is crucial to understand that stocks often trade at truly foolish prices, both high and low. Efficient markets exist only in textbooks. In truth, marketable stocks and bonds are baffling, their behavior usually understandable only in retrospect. So this paragraph is actually quite interesting since it is a hard hit to academia, since he absolutely do not believe in the efficient market hypothesis, since efficient markets exist only in textbooks, and you have to recognize this fact that it is only retrospectively understood what the true value of the business would be, and they are very often traded at foolish prices, both too high and too low. And the trick is, of course, to know when it is too low and buy a ton of it. This is the phrase that he's often quoted for, saying you need to be greedy when others are fearful and fearful when others are greedy. If we then continue, then the next paragraph, I will skip that since that is about controlled businesses, and that's only relevant if you are buying an entire corporation outside the stock market. So that is not for you and me. We are simply not in that ball game currently. And if we then continue to the next paragraph, at this point, a report card from me is appropriate. In 58 years of Berkshire management, most of my capital allocation decisions have been no better than so-so. In some cases, also bad moves by me have been rescued by very large doses of luck. Remember our escapes from near disaster at US Air and Solomon? I certainly do. Our satisfactory results have been the product of about a dozen truly good decisions that would be about one every 5 years, and a sometimes forgotten advantage that favors long-term investors such as Berkshire. Let's take a peek behind the curtain. I find these two paragraphs extremely interesting. I mean, when you think of Warren Buffett, he has at some point been the world's richest man, but still after 58 years of investment management, he still do not think of himself as having better than so-so capital allocation decisions, and even in some cases bad. I mean, how can you stay this humble when you have been the world's richest man? I truly believe this is one of the secret successes for Berkshire Hathaway, that they don't think that they are better than everyone else. They simply just fully acknowledge the fact that shares in the majority of times trade at absolutely foolish valuations, both high and low. And Charlie Munger is actually famous for saying the only reason why they are rich is because there are so many idiots in the world. If we then continue here with the secret sauce, in August 1994, yes, 1994, Berkshire completed its 7-year purchase of the 400 million shares of Coca-Cola we now own. The total cost was 1.3 billion, then a very meaningful sum for Berkshire. The cash dividend we received from Coke in 1994 was $75 million. By 2020, the dividend has increased to $704 million. Growth occurred every year, just as certain as birthdays. All Charlie and I were required to do was cash Coke's quarterly dividend checks. We expect those checks are highly likely to grow. American Express is much the same story. Berkshire purchase of Amex were essentially completed in 1995 and coincidentally also cost 1.3 billion. Annual dividends received from this investment has grown from 41 million to 302 million. Those checks too seem highly likely to increase. These dividend gains through pleasing are far from spectacular, but they bring with them important gains in the stock prices. At year-end, our Coke investment has a value of 25 billion, while Amex was recorded at 22 billion. Each holding now account for roughly 5% of Berkshire's net worth, akin to its weighting long ago. Assume for a moment I had made a similar sized investment mistake in the 1990s, one that flatlined and simply retained its 1.3 billion value in 2022. An example would be a high-grade 30-year bond. That disappointing investment would now represent an insignificant 0.3% of Berkshire's net worth and would be delivering to us an unchanged 80 million or so of annual income. The lesson for investors: the weeds wither away in significance as flowers bloom. Over time, it takes just a few winners to work wonders, and yes, it helps to start early and live into your 90s as well. So the secret sauce here is, with just these two good investments, he can actually afford to make a lot of bad investments, since the $1.3 billion has either increased to 22 billion or to 25 billion. So if you invest in individual businesses, if you just have a few that is truly extraordinary, they will by far outshine the weeds, or as it says here in the lesson, the weeds wither away in significance as the flowers bloom. And even though here he fully recognized that it is nice to receive these ever-growing dividends, they are pleasing, but they are far from spectacular. I actually find that quite interesting as well. So this was a lot about investments. If we then move over to the more personal lessons from Buffett, then if we turn here to page 9, nothing beats having a great partner. Charlie and I think pretty much alike, but what it takes me a page to explain, he sums up in a sentence. His version, moreover, is always more clearly reasoned and also more artfully, some might add bluntly stated. Here are a few of his thoughts, many lifted from a very recent podcast. The world is full of foolish gamblers, and they will not do as well as the patient investor. If you don't see the world the way it is, it's like judging something through a distorted lens. All I want to know is where I'm going to die, so I'll never go there. And a related thought: early on, write your desired obituary, and then behave accordingly. If you don't care whether you're rational or not, you won't work on it. Then you will stay irrational and get lousy results. Patience can be learned. Having a long attention span and the ability to concentrate on one thing for a long time is a huge advantage. You can learn a lot from dead people. Read of the deceased you admire and detest. Don't bail away in a sinking boat if you can swim to one that is seaworthy. A great company keeps working after you are not. A mediocre company won't do that. Warren and I don't focus on the froth of the market. We seek out good long-term investments and stubbornly hold them for a long time. Ben Graham said, "Day to day, the stock market is a voting machine. In the long term, it's a weighing machine. If you keep making something more valuable, then some wise person is going to notice and start buying." There is no such thing as 100% sure thing when investing. Thus, the use of leverage is dangerous. A string of wonderful numbers times 0 will always equal 0. Don't count on getting rich twice. You don't, however, need to own a lot of things in order to get rich. You have to keep learning if you want to become a great investor. When the world changes, you must change. Warren and I hated railroad stocks for decades, but the world changed and finally the country had 4 huge railroads of vital importance to the American economy. We were slow to recognize the change, but better late than never. Finally, I will add 2 short sentences by Charlie that have been in his decision clinches for decades. Warren, think more about it. You are smart and I am right. And so it goes. I never have a phone call with Charlie without learning something. And while he makes me think, he also makes me laugh. So as I promised in the beginning, this letter contains not only a lot of investment advices, but also how you should behave as a person. And these quotes certainly proves that point. The ones which I found the most interesting is specifically the last one here. Warren, think more about it. You are smart and I am right. And then number 3 up here, that early on write your desired obituary and then behave accordingly. Unfortunately, I think this is a thing that people learn too late in life, so they do not adjust their behavior so it is possible for them to be remembered the way that they want to, simply due to the fact that they are adjusting their behavior too late in order to make it possible to be remembered the way they wanted to. So this was a lot of lessons from Buffett's annual shareholder letter, both regards to investing and to live your life in general. So hopefully you have learned as much as I did when I was making this video and trying to present it for you. That is at least the intention for me. And I can only encourage you to go and read the full letter. And I will of course include a link in the description below for your convenience. So if you have enjoyed the content, then please consider leaving a like or subscribing to the channel. It really helps me out. And until I see you next time, bye.